We're looking at supply and demand, and we're saying, okay, what are some of the implications of the problems that arise if we allow the market to operate freely? I just wanted to talk about these quotas, the idea of taxes, and the idea of some form of a subsidy here today. So a quota, what a quota effectively does is it limits the amount of production that can enter the market. And it does that by saying, okay, to a farmer or form of producer, it is government imposed on a producer to say, producer, you can only produce so much. We will allocate to you so much production. So if you're producing chickens, carrots, milk, eggs, whatever, the quota says that you can only make so much of it. In Newfoundland, the fishermen are usually subject to quotas. You can only go and harvest so much cod. Now, that has an environmental benefit, too, because what it says is that not all the cod are going to be hauled out of the ocean. You know, it limits the amount of cod that are being pulled out, and it preserves the stock. But usually a quota has to do with, the whole purpose of it is more to do with the market than anything else, and that is we don't want too much on the market, which would effectively drive down prices. So we limit the supply, which is what a quota basically does. We can keep the prices buoyed up. So using production quotas instead of target market prices, the government aims to affect the total output coming onto the market. It does this by introducing legislation to prevent producers from exceeding or stipulating a limit on the production and the sale of the product. Now, this is not, quotas are not very popular with producers because effectively what it does is it says to producers, we are going to tell you how much to produce. And, you know, from a free market perspective, that's not going to go over too well with private enterprise. So here we can see a graphical representation of a quota. Here in the red line is your demand for a given product across a range of prices. The blue line is a supply of a product, okay, at across a range of prices. Now, so what we have, we're focusing on the supply because quota affects the supply or impacts the supply. So let's assume that one of the things that farmers can do is grow carrots, we'll say carrots, really well, okay? And we know that, you know, they're thinking to themselves, look, if we could grow 2 million pounds, 3 million pounds, 4 million pounds, 5 million pounds, or kilos, or whatever, we could make more money. And we see, for example, here that more supply theoretically can make more money. So if the free market were in place, we see that farmers growing carrots would produce 6 million. This is the equilibrium point. We look down, we say, okay, look, they could produce 6 million carrots. The thing is that they would only be able to get a price of $4 for 6 million because the equilibrium point suggests that that is the price that you will get. Now, the problem is farmers can't live on $4 because it's effectively not going to make them enough money. They're going to go to government and complain and say, well, you know, how in the heck are we supposed to continue as farmers if we can't make enough money? So government says, okay, well, we'll help you out. We'll set up a quota system. We'll set up a quota system that it pains everybody equally, we'll call it. What we're going to say is that the maximum production that we can produce in total for all producers is, in this case, 4 million kilos of carrot, okay? So instead of the free market amount of 6 million, we're going to cut the production by 2 million pounds or 2 million kilograms. Now, so farmers don't have to grow as much. Government's going to allocate to them a certain degree of how much they can produce. And the net effect of that then would actually drive up. If we look up here, we say the intersection of the quota line then will be a 4 million across the board regardless. We're seeing that the farmer will now get $6 a kilogram for carrots. Farmers have increased the amount of money that they can get for the carrots from 4 to 6. So the farmers have a smile on their face in the sense that they're making 6. The downside is that they're not selling as much. There's not as much being produced, but they're making more on what they're producing, okay? So the idea behind a quota is that if we can limit the amount, we can get the price higher, so farmers will make more money. And that's the basic gist of a quota. And quota systems are in existence across Canada. We have what's called a managed market in the farming industry here in Canada. And effectively, there's all kinds of quotas out there for farmers for everything from grain to fish to carrots to pigs to goats and everything else. And what it does is that the intent of it is to drive up the price and allow farmers to make a decent living. Yeah, it preserves some farmers, no doubt. But in the meantime, guess who pays for it? You used to be in a free market, be able to get that carrot for $4. Now you have to pay $6. And we see that every time we go buy a carton of milk in the store, we're paying $4 and change for a carton of milk. And the reason is that there's a quota on milk, and that really government says we're going to help the farming industry out by putting more, we're restricting the amount of milk, which effectively drives up the price. And even though people are paying more for it, it's not as if they're going to go anywhere else to buy the milk. There's no competitor in there, really. They might switch to other products, but we regulate the price of milk effectively. Farmers make more money. It keeps them in the business. Okay, so that's that's that issue right here. We can look at this very simple example here. In 7, it says the market for soybeans is described in equilibrium. What is the total sales revenue being received by producers? So if we look at equilibrium, it's right here. That's $400 a ton. Is that? And 8 million tons. So 4 times 8 is 3.2 million or 32 million or whatever it is. 32. 32 is what you would get there. So that's the total amount of income that this soybean industry is producing. Now, suppose the government imposes a quota of 6 million tons. So effectively, there's going to be a straight line going up from here. That straight line then would mean then that the new equilibrium price would be right there where my arrow is. What will be the new price per ton? Well, the new price per ton will be 6. And what will be the total sales revenue? So if you look at the total sales revenue at this, it's 6 times 6, which is 36. So we went from 32 to 36 in terms of the total revenue. So government, by putting in that quota, has increased the total revenue of the industry, which means that the farmers are happy. They can't produce as much, but they're making more on what they're selling. So that's generally what's got. Now, if you're a buyer, you've gone from originally paying a price of 4 or 400 to a price of 600. So you're not happy, but the producers are. These excise taxes are a bit of a trick. And excise taxes are another common tool that government uses in order to restrict people from buying things. And, everything from cigarettes to gasoline to usually bad stuff that we're going to buy anyway, booze. Usually all that stuff has a lot of excise tax on it. Now, effectively, a tax is just an extra price that they put on a product, that government imposes on a product, that goes to government, that effectively is a per unit basis. So, for example, it's like 50 cents on a liter of gasoline, or 30 cents on a pack of cigarettes, or $6 on a bottle of wine, whatever it is. These excise taxes effectively go straight to government. And it's a very good money generator for business, for government, because one of the things is that if it's a product that business sells that people have to buy, gasoline, booze, cigarettes, they're going to buy them. We can be able to, it's not very, and we'll get into this later on in the course, but it's not very what's called elastic. People are going to buy it anyway, regardless of what the cost is. They know that. And when they know that, they can easily add tax to it, because the demand doesn't change that much, and they can make a lot of money on it. So here is and this is a little bit of you got to wrap your head around this. So what I've done is just broken it into its this basic example I give, I've just broken into its key components, okay? Assume that the equilibrium price for a given item is $5. Okay, so in the example that is here, this is energy drinks, okay? And so we're going to assume that the equilibrium price is $5. So here we go. We see the quantity demanded and the quantity supplied. Is equilibrium, I should say, not the equilibrium price is $5. Equilibrium quantity is $5. My mistake. The equilibrium quantity is 5. So we see that, and that's $8. So I need to change that. I'm just going to change that to 8. Okay. So with that equilibrium price at $8, we're going to further assume that what government says is, we see an opportunity here to charge extra in a form of a sales tax on this. We don't like people buying energy drinks or booze or cigarettes or gasoline because it has negative consequences. So what we're going to do is we're going to bring forth some extra charge on this. So in this particular instance, it's $2 a unit. This will effectively cause at every single price point a $2 increase in the product. Okay? So we see, for example, here that, it was 5 and we had 8 and 2. It was 6 and we had 7 and 3. Now, once the price goes up by $2, so that changes to a 7, that changes to an 8, you can see how that effectively the amount supplied then would adjust accordingly. So that 5 was a 7. That 7 was a 5 beforehand, and now the quantity is down by 2 units. And we see effectively then what happens is that at any given supply point, okay, at any given supply point, effectively it drives the supply line up. Initially, the 6-pack price will increase from $8 to $10. So we see it go from 8 to 10 because of that $2 extra. Instead of receiving $10 now, the producers are only receiving 8. And they're going to try to produce the same amount of product. So effectively, we get this gap on the go here. And this means that really the effect of a $2 per 6-pack excise tax is to shift the supply curve from S1 to S tax. The result is equilibrium price will increase from $8 to $9. You can see the equilibrium price was here, and when this shifts up by $2, it effectively causes the equilibrium price to move up. You see that it's gone up to $9. So we see that the net effect in terms of the quantity per cases is from 5 to 4, which is really what it's intended to do, right? We want to impose the tax so people won't buy as much. So we do see a reduction in the amount of product that's sold. But in the meantime, we could argue that if with this $2 tax that's put on here, we've driven up the equilibrium price by $1. So that means that people are paying $1 of that $2 increase, the customer is, and the company is absorbing the other $1 increase. The subsidy kind of works in reverse. What a subsidy tries to do is to encourage people to buy things. So, like daycare. In this past election, the federal election, for example, one of the big topics was $10 a day daycare. So what the government will do, what the federal government is proposing they'll do, is they will subsidize daycare so that you and I will have to pay no more than $10 a day for each one of our children to go to daycare. Right now, we might be paying $20 a day to go to daycare, or $50 or $100, whatever it is. But the difference between what we pay now and what we're going to pay after the subsidy goes in would be the amount of the subsidy. And the idea is it makes it less expensive for us as buyers to buy that particular product, in this case, daycare, so more kids will be able to go to daycare. So subsidy is a form of financial aid given by the government to an institution, such as a daycare, business, or an individual, such as it could come directly to me or you. We could get it in the form of a grant, right? Which is generally aimed at promoting economic and social policy. A subsidy given to producers will increase the supply. So we see that here in this particular example. So in this particular example here, we've got our supply one right here, which is the original supply before there was ever a subsidy put in place. And here is our demand before there was ever a subsidy put in place, okay? So effectively then the equilibrium point, the point of which the price would be $2 a dozen. $2 a dozen. We can see that $2 a dozen and the demand would be 40 million dozen. So $2 and 40 million dozen. So let's assume then that there is a $1 subsidy put in place, a $1 subsidy. And that will shift the supply curve down. So we're going to see the supply curve move from right here down to right here. Okay, so we're actually driving this down. The net effect of that then is to decrease the price to you and me. So we see this was the price, $2. Now because of the subsidy, the price has dropped. In fact, it's dropped to $1.50. And not only has the price dropped, but look at what has happened to the quantity supplied. It was 40 million. Now they're willing to supply 60 million. So from a government policy point of view, that subsidy to daycare operators or whatever this type of business is, egg production, whatever, this will allow the price to be dropped, which is a good thing because, you know, less expensive for us to buy. And because effectively they're making more money on it, because of the subsidy, they're going to supply more. So it'll generate a bigger supply. This is very good for things like daycare and stuff like that, which has a social, I'll call it a social good. So those are the things that you really need to look at with regards to how government gets involved in order to kind of encourage or discourage a particular activity. Looking at this particular example here, test your understanding, the market for the industrial milk, and now industrial milk is milk that's used to make cheese and ice cream and stuff like that, in millions of hectoliters, is described in the following graph. So here we got a standard graph that shows, okay, here's the demand, and you can see as the price goes down, more and more is demanded. Supply, same thing. It's a price, or the opposite thing. As the price goes up, more and more is supplied. The equilibrium in this particular example is 80 per year, 80 million hectoliters, whatever. But anyway, 80 per year. And the price would be, in the free market, $70. So if a subsidy of $30 per hectoliter is given to milk producers, draw the new subsidy curve. So let's just look back at this one here. And what the subsidy does is it drives the supply line down, okay, by the amount of the subsidy. So in this particular instance, the subsidy is $30, okay? So this would mean that you'd get a new curve that goes up parallel to this one that is 30 below it. So starting at 0, working its way up here. So along that type of line here. This would mean that the new equilibrium point will be right here. And that would mean that there'd be more product. The equilibrium would mean that there'd be more product offered, around 120, and the price of that product would be lower. around 60. And that would create the new equilibrium price would be about that in order to do that. And that would, again, the subsidy encourages more production, and effectively it would reduce the price.